Okay, first thing we're going to talk about. By the way, notice the title here, risk and return. One of the things we're going to figure out is in finance, risk and return have to go together. And this makes perfect sense. In my hometown of Carthage, Missouri, there were 3 industries. There was cheese, and there were bed springs, and then there was a dynamite plant. Which of those 3 do you think paid the most?
Dynamite.
The dynamite plant. Because?
Because we like to blow stuff up.
Well, yeah. Who doesn't, right? But it was the highest risk job in town. Does that make sense? So my dad, both my grandfathers, my uncle, all worked at the dynamite plant, and we were slightly better off as a result. But of course, we also had the chance that Dad wasn't going to come home because he did get blown up twice. Okay, now let's talk about returns. Returns are what you get in exchange for taking risk. And in financial securities, we talk about 2 sources of returns. And it's either going to be these payments that we receive along the way. So like you're going to hear about coupons on a bond, hopefully FIN 38600, they taught you about coupons. Or what would be the periodic payments on stock? Dividends. Dividends. Now, not all stocks pay dividends, and we'll get into that, but those are the cash flow streams. And the other thing that you can get from owning a financial instrument is the capital gain. And that is the difference between what you sell it for and what you buy it for. And so the value of the thing goes up. And so if you bought Apple shares a long, long time ago, you would have some dividend income from that right now, but you would have a huge capital gain. So for the purposes of our discussion today, we're going to discuss these things in terms of stocks. But I could just as easily talk about this in terms of the payments that we receive from bonds and the capital gain. So let's talk about 2 kinds of returns. And the first kind are dollar returns. And these are just the returns that you get on your investments in dollars. And so let's talk about the advantages and disadvantages of dollar returns. If I know my dollar returns, I know exactly how much more I can consume at this point in time as a result of having made an investment. And so I could say, oh, wow, I had $30,000 return on this investment. Now I can buy a new Toyota Corolla or whatever it is that I want. So that's the gain from dollar returns, is that we know the amount of money at the time, and we also know what that will buy. So let's talk about an example here. You're going to buy 100 shares at $37 per share. The stock pays an annual dividend of $1.85 per share. By the way, most dividends are quarterly. Just for ease of calculation, we're going to make these annual. At the end of the year, the stock is selling for $40.33. So we want to know what's our total dollar return on the stock investment for the year. Let's start out on a per share basis, and then we'll jump to what's our total dollar. On a per share basis, how much do I make on each share from dividends during the year? Yeah, $1.85, right? How much did I make in capital gains?
40 minus 37.
And can you do that in your head?
$3.30.
$3.33. Very good. Okay, now, if I add those 2 things together, $3.33 and $1.85, I believe I get $5.18. Yeah, $5.18. Okay, now, knowing that I will have 100 shares, what could I do next, James Sunday? If I've got $5.18 and I've got 100 shares, what can I do next to figure out my total dollar return? I just got to multiply it by 100, right? So $5.18 times 100 tells me $518. And so that's the answer. Now, there was another way we could have gotten to that. We could have figured out the dollars from dividends, and we could have figured out the dollars from capital gains simply by multiplying each of those smaller numbers by 100 and then adding them together. The way that I just did it saved us a step. Does that make sense? Saved us a step. Okay, so we've already mentioned the benefit of stating the returns in this way, but what piece of information does it ignore? So I'm going to give an example here. Ms. Armbruster and I are at the party. It's a cocktail party. By the way, for this, I'm going to play the role of Lance, a single man, right? Okay. I come up and I say, hey, I just had $518 in total returns. Does she know whether to be impressed or not? It depends. Why?
How much did you invest?
Yeah, how much did you invest? And so she's going to say, well, how much did you invest? And I'm going to say $1 million. Exactly. I heard a snort over here, right? She doesn't, she's like, what? I get better than that on my savings account, right? Yeah. Okay, now what if instead I say $1,000? Are you impressed? You should be, right? 51.8% return in a year? Oh, yeah. Okay, so I'm no longer Lance. Put the wedding ring back on. Okay. I gotta let you guys know that I'm playing a different character when I do that. Okay, back to the story. It ignores how much we initially invested. So how are we going to talk about that instead? Percentage returns. Percentage returns compares to how much we initially invested. And the percentage of the returns that come from dividends is called the dividend yield. The dividend yield. And how do we calculate the dividend yield? It is simply, by the way, this is what these subscripts mean. Dividends, T plus 1, means the dividends at the end of the period. P sub T means the price at the beginning of the period. So in order to collect those dividends, I had to buy that stock at time 0, and here we are at time 1. How much am I going to receive in dividends? That's really easy to figure out. Our percentage return from capital gains is a little more difficult to figure out because the first thing we have to do is figure out our capital gain per share. So I've got to take the price at time t plus 1, the price at the end of the period, minus the price at the beginning of the period, which we said was what, $3.33, and then divide by the price at the beginning of the period. And the cool thing is, if I just add these two things together, that gives me my total percentage return. That gives me my total percentage return. Okay, so let's walk through the math here. First of all, we can calculate our dividend yield. By the way, if you look at stock quotes in the Wall Street Journal or anywhere else, one of the pieces of information they will give you is the dividend yield of the stock. And basically that is what percent of your investment can you expect to collect during the year. So we've got our dividend at the end of the year of $1.85 divided by the price at the beginning of the year of 37 gives us 0.05, which is 5%. So I would say the dividend yield of this stock is 5%, or this stock yields 5% in dividends. Now what about the capital gains yield? At the end of the year, it's selling for $40.33. We subtract out that initial 37, gives us $3.33. Divided by $37 gives us 0.09 or 9%. Now, how do I figure out the total percentage returns? I add those together and get 14%. By the way, people often say, wait a minute. If I don't sell the stock at the end of the year, I don't get the capital gains yield. So my return is only the dividends. Wrong. Because you could sell the stock. You could sell the stock on December 31st and repurchase it on January 1st, and you would have captured those capital gains. Now, next year, what if the stock price drops? Well, your capital gains will be negative, right? But we always can figure out that return, whether we buy or sell, will we sell the stock or not. Now, let's check our work. Our initial investment, $37 per share times 100 shares, tells us that we invested $3,700. $3,700, and then I multiply by, or I take the 518 divided by that, and that's our, by the way, 518 is our total dollar return, right? 518 divided by 3,700 gives us 14%. So it all checks out. Okay, now we're back at the singles party. I am back in the character of Lance, the unmarried man. And I come up to Ms. Armbruster. By the way, Ms. Armbruster, are you single? You aren't? Oh my goodness, I need to talk to someone else. I am so sorry. I would never. Oh my. Are you single? Yes! Besides, she wants my money. Okay, so I come up to you at the party and I say, I just had returns of 14%. Do you know whether to be impressed or not?
No.
Now, let me ask you this question. Do you know whether that 14% is enough money for me to buy you dinner or enough money for me to buy you a Lamborghini?
It depends on what initial investment
Yeah.
amount is.
And so once again, if we don't know that initial investment, we don't know, right? So there's still a piece of information missing. Both of these are useful, but they both fall short of giving us a complete picture. By the way, if you meet a man at a party, and he claims to have money, always get a credit check before you make any sort of plans with him. You guys think I'm kidding, but I'm not. Okay, ring back on. Okay, so here we go. Now we are going to talk about historical returns. And this chart is a log normal chart, which is really messed up. Because if you look at that vertical axis, the vertical axis goes from 0 to 1. Now, what do you expect to happen next? To go from 1 to 2. But instead, what happens? It goes from 1 to 10. And then it goes from 10 to 100. And so this is the log scale. Now, why in the world would we do that? The purpose is, because we're trying to actually demonstrate returns here, the purpose is to make a 10% return up here in the big numbers equal to the same size as a 10% return down here in the small numbers. Otherwise, this thing's going to be kind of really cranked and we won't be able to interpret it properly. So that's why it is this kind of log normal thing. Okay, now the next thing that I want you to notice is we have this time scale on the bottom. And the time scale goes from December 31st, 1925, and I think this one goes all the way to the end of 2013. And if we did it even further, you would see that it's just more of the same. Okay, now let's talk about why we don't have data before December 31st, 1925. We have been trading stocks on the New York Stock Exchange, or back then it was called under the buttonwood tree, for like 300 years, right? It's been there a long time. But we only started keeping good records January 1st, 1926. And so all the finance research that you see out there, most of it is based on data just starting January 1st, 1926. And so that's why we have this data. We have the data only going back to that point. It's not reliable prior to that. Okay, now let's talk about what these different things represent. Down here at the very bottom, we have inflation. We have inflation. Now, can you invest in inflation? No. But what we need to know is that in order for these things to have real returns, positive real returns, in other words, they improve your ability to consume, they have to return more than inflation. Because if they return less than inflation, you're actually losing purchasing power by making the investment. The good news is every single investment up here has returned more than inflation. Now, what does this mean, $12.81 at the end versus $1 at the beginning? It should mean that in 2013, I could buy the same basket of goods for $12.81 that I could buy for $1 on January 1st, 1926. And having talked to my grandfather, who was alive during this time period, and based on the prices of things that he would tell me, I think that's probably about right. So I have no reason to question that. Now, the next line up is something called treasury bills. And if I invested $1 back in January of 1926 in treasury bills, I would have had $20.57 at the end of 2013. Now that sounds pretty good. I've got more than 20 times as much as I started out with. And we know that's more than inflation, so investing in T-bills over this period would have increased my ability to consume. Now let's talk about what treasury bills are.
So even though it's 20 times more, based on inflation, which has been 12 times more, it's really just a subtraction of 2. So really what you could buy for $1 back then, you could only buy $4 now.
Okay, so we will get to the calculation you're talking about when we get to chapter 5. The way you're stating it is actually the approximation. I will give you the exact.
Okay.
Okay, let's talk about what treasury bills are. Treasury bills are the short-term borrowings of the United States government. Treasury bills are the short-term borrowings of the United States government. And you know already that in finance and accounting that short-term means less than a year. And in this case, we are talking about 3-month treasury bills. 3-month treasury bills. Now, when you loan money to someone, there are 2 kinds of risk. Have any of you ever loaned money to a friend only to have them not pay you back? That's part of the human experience, right? And we call that default risk. That's default risk. Now, there's one other kind of risk. Oh, very good. She's jumping ahead. One other kind of risk when you loan money to people, and that is interest or price risk. Okay, remember I told you back at the end of chapter 4 that the price or value of anything is the present value of the future cash flows discounted at a rate appropriate to the risk. And so the price today is equal to that present value is equal to, and let's assume it's a lump sum payment out there in the future value divided by 1 plus r to the t. Okay, now as interest rates go up, this thing gets larger. The future value stays the same. The price goes down. But if interest rates go down, this thing gets smaller. We divide by a smaller number, price goes up. And so we see that interest rates and the price of things, the price of financial securities, do like this. When the interest rates go up, the price of the stuff goes down and vice versa. We're going to see that is mechanically, mathematically true for sure in bonds. And we'll see that it impacts stocks too, but not just nearly as perfectly as it does for bonds. Now, here's the fun thing. What do you think T stands for? Time. And right now we are working with the 3-month treasury bill. 3 divided by 12, which is 12 months in a year, 0.25. And so for the treasury bill, this little t is 0.25. So whatever change in interest is getting magnified up to the 0.25 power. Is that big? Nah, that's pretty small, right? 0.25. We're not going to change things a whole lot. This number's not going to change a whole lot based on R. But what if we're looking at a 30-year treasury bond? This number goes from 0.25 to 30. And now whatever little change there is in R gets magnified to the 30th freaking power. That's huge, right? And so what we're going to say here is that the longer the time to maturity, the longer this thing is hanging out there, the greater the interest risk. And so from that perspective, we know that treasury bills have very little interest or price risk. Now, what about default risk? What do you think the default risk is on treasury bills?
You said the higher the risk for that, right?
So-
The longer the time to maturity.
Yeah, the longer the time, the higher the interest or price risk. But for these things we're talking about right now, the time is only 0.25, so the interest risk or price risk is tiny. It's tiny. Okay. Now, let's ask one more time. By the way, the borrower is the United States government. What is the default risk?
0.
In theory, 0. Now, my next question to you is, has the United States government ever defaulted on its debt? Yes. Roll yourself back to the American Revolution. By the way, we had our own currency then. It was called the Continental. And the Continental was so worthless that people were using it as toilet paper. That's how worthless it was. Okay, so we can't get out of the situation of being in debt for the war by printing money. No one's going to accept it. What kind of currency was being used in the United States at that point, other than this toilet paper? The Spanish dollar. The Spanish dollar. Because we're just like right north of Central America where all that money's being mined. There we go. We got the Spanish dollar. Okay, but we don't control our own currency. So we can't just print currency. We would have to buy those Spanish dollars. We would have to trade our way to get that money. We didn't have the ability to do that. In fact, we were just a bunch of poor dirt farmers. I don't know if you knew that, but America was a very poor country. You might call it third world today. And basically, all we had was our land and a dream. Now, we owed big money to a certain country in Europe because of the war. Who did we owe the money to? France! France loaned us money to help fight the British. In fact, they sent some troops and some ships too. Now, do you think the French did this because they love Americans so much? Anybody here ever been to France? Do they love Americans? No. The French hate everybody, but here's the trick. They hated the British more than they hated us, right? And the enemy of my enemy is my friend. So they loan us the money, we win the war, and so then they come to the after-war party. By the way, you guys didn't read about this in the history books, but there it was, the after-war party. And the French show up and they say, "Ho, ho, ho, ho! Congratulations! You're a nation!" And we say, "Thanks." And they say, "Pass the money." And we say, we turn our pockets wrong side out and we say, "Hey, we're just a bunch of dirt farmers. We spent that money on gunpowder and lead. By the way, that's all gone, right? We don't have anything to pay you with." And so the French are like, and they take off, and then they kind of get distracted by something that happens immediately thereafter in France. What was it? The French Revolution. We're like, yeah. Right? So we never paid them back. Now, we did rescue them twice in World War I, World War II, so I think we're even, right? Okay, back to the story. America, the United States government, has defaulted on its debt, but not in modern times. And there are two reasons for that. Number one, we can print money. But what's the problem with printing money? What happens? Inflation. You're living through it right now, baby, right? You guys are seeing it firsthand. So that's a problem. Now, the other thing is that, in theory, the United States government can raise taxes in order to cover its debts. By the way, we're still a rich country, even though we're deeply in debt. The United States government can raise taxes. But here's the problem. What kind of government do we have? What form?
Democratic.
Yeah, it's a democracy, which means that we elect our officials. I think there are only 2 people in the room old enough to remember this. Do you remember when Walter Mondale promised to raise taxes if he got elected? Do you guys ever remember a President Mondale? No! That's because we voted against it, because he said he'd do what? Raise our taxes. And so I'm telling you that theoretically, it's entirely possible that the United States government is default risk-free. In reality, there are probably limits to that. But for the sake of the argument here, we're going to say that the Treasury bill is both free of default risk and free of interest or price risk. We're going to say, for sake of argument, that it's both free of default risk and it's free of interest or price risk. It's certainly the safest thing on this chart. I can tell you that with certainty. Okay. Now, we also, in finance, we talk about something called the risk-free asset. And the risk-free asset is a theoretical construct, but the closest thing we have to the risk-free asset is this treasury bill. And so when we need the risk-free rate for some of these theoretical calculations, we will always use the yield on the 3-month treasury bill. That's going to be our risk-free rate. Okay, now, knowing that this is the least risky thing up there, does it make sense that it's also the lowest one on the chart other than inflation? Yeah. And so we know that investing $1 there only gives us $20.57. Now, the other thing I want you to notice about that line, it's very smooth. It's very smooth. And so we can see that as we go from smooth to rough on those lines, we're going to be going from safe to risky. And as we go up, I want you to notice that as we go up, it gets riskier, and therefore those lines get rougher. What do I mean by rougher? Right? Jumping up and down. Why does the jumping up and down represent risk? Think about this. You are at retirement. You now need your money, right? You don't have a job. You're totally depending on your retirement wealth. Would you rather have $1 million in treasury bills or $1 million in small company stocks? Yeah, you'd rather have treasury bills, and here's why. Because with small company stocks, it would be worth $1 million today. Tomorrow it might be worth 1.1 million, but the day after it might be only worth 900,000, right? Now, this is getting us to another thing, and that is how much risk can you stand? When you are young and you have your whole lives in front of you, you can stand more risk because you've got more time for these asset prices to recover before you retire. Now, what if you're saving money for a down payment on a house? Would you put it, oh crap, would you put it in the small company stocks or in the T-bills? You're saving money for a down payment on a house. Are you going to put it in the treasury bills or are you going to put it in the small stocks? Yeah, you got to put it in the T-bills. Any kind of money that you're going to need with certainty in the short term, you should not be putting into these risky things because there's always the chance that tomorrow the bottom will fall out. It's so interesting. When I used to teach China EMBA, we would have lots of Chinese people would hit the ground, and as soon as they figured out I was a finance guy, they would come ask me and they would say, "How can I invest in stocks?" And I say, let's ask about the money you're going to put in. Well, that's the money I'm going to need for my rent and to eat while I am here. Do you think I told them, oh yeah, go put all your money in stocks? No, they were going to need that money in the next 12 months. You don't know what's going to happen to the stock market in the next 12 months, right? Okay. So then after we get through with treasury bills, then we move on to long-term government bonds. By the way, the borrower for long-term government bonds is the same as the borrower for treasury bills, the United States government. Now, in theory, the United States government is free of default risk. But these long-term government bonds mature in 30 years. What does that tell us about their interest or price risk? Yeah, it's going to be higher, right? So all that extra risk that you see for long-term government bonds and all the extra return you receive for investing in long-term versus the short-term, it's all due to interest rate or price risk, purely. Okay, and keep in mind that's because we're magnifying that thing to the 30th power, so even the smallest increase in interest rates is going to cause the value of those things to go down. Now, what does the smoothness of the long-term government bond line look like versus the treasury bill? It's not quite as smooth, right? It's a little rougher. So we're moving away from smooth toward rough. We're moving from safe toward risky. But as a result, though, how much do we have at the end? We have like 6 times as much. We have 6 times as much. Silence this thing. Okay, we have 6 times as much. The only reason we have more is because we've taken on more risk. Does that make sense? Okay, now, there is something missing from this picture. Because we're going from long-term government bonds up to large company stocks. And in between, we should have large company bonds. Now let's ask, why are the bonds of a firm safer and therefore will return less than the stock? And the answer has to do with the order in which people get paid. Remember that there's this line of people with their hands out for money, and we've got the government and suppliers and all that other kind of stuff, and in that line are also the bond holders. And they get paid before, who's in the very back of the line? Common shareholders. That means they've got a riskier position here in the back of the line. Therefore, what must their return look like? It's got to be higher, right? And so we know that the large company bonds would fall in between those two lines. And here's why. It's got the same interest or price risk as a long-term government bond of equal maturity, but it also has default risk. Is it possible for a company to default on its bonds? Absolutely. You're going to have a discussion on Evergrande, which is a big real estate company in China, just defaulted on its bonds. It's absolutely possible. Now, it's not as much as you might think. For instance, we're going to talk about junk bonds in this class. Junk bonds sound like absolute crap. But 95 to 96% of them still manage to make it to maturity if people don't lose money on those. But that does mean that there are 4 to 5% of them that get defaulted on. So there is default risk. Okay, then we move on up to large company stocks. And if I invested in large company stocks, oh my goodness, $3,532.56. That's flipping huge, right? Are you looking at this other stuff now and saying, whew, there's no way I would put my money in those other things? That's because you're young, right? You're young and you're not going to need this money. By the way, my dad is 83. Do you think he should be out there putting all his money on small company stocks? Absolutely not. Okay, now large company stocks, $3,532.56, and that looks pretty good. Now it does look rougher than the long-term government bonds. We know that means it's riskier, that's why it's got to pay more. But what pays even more than large company stocks? Small company stocks. Look at small company stocks, $18,364.60. Oh my goodness. That is huge! That is huge! Now, am I telling you that you, because you're young, should go out and invest in nothing but small company stocks? No, I wouldn't give you that advice. You could if you wanted to, but that's the only advice that I will give you long-term is that if you invest in the S&P 500, you can expect a positive return. That's the only financial advice I can give you. And then when people come and tell me I lost money on the S&P 500, I say, just wait a while, right? It'll go up. And it will. Okay, now let's see here. Let's ask the question, why do you think small company stocks are riskier than large company stocks?
Small companies are more likely to default than large companies.
Okay, why?
They have less resources,
Less
less
capital.
people.
Yeah, they have less resources, less capital. And let's think about this. If it's a larger company, it's got a higher chance of being in more than one line of business. Does that make sense? So let's compare General Electric and a small Chinese startup, and they both make windmills to make electricity. And for General Electric, the income from that line of business is a rounding error. For the Chinese startup, it's everything, right? Now, if the windmill business is going great, what's going to happen to the stock of the small Chinese startup? Whoop! What's going to happen to GE? Right?
It's relative.
Yeah, it's all relative. It's tiny. Now, what happens, and this is actually what's happening. Governments are like, you know what? We're tired of subsidizing these stupid windmills. They kill the birds, and they piss off the neighbors. We're tired of that. Let's stop it. What happens? The Chinese startup basically dies, right? What happens to GE? We're okay, right? So there's number one. Or number one is the more resources. Number two, more diversified. And number three, I would tell you this. Unless it is started by a government, every company starts out as small. Does that make sense? So if you start out as small, how do you get to be big? You have to make some good decisions. Back in 1996, I went alligator hunting down in Louisiana. And I know some of you don't like this, but we're shooting alligators, and we saw this 12-foot alligator. By the way, for Louisiana, that's big. There's a 12-foot alligator. And my Cajun buddy said, "Whoa, that must be a smart one." Now I'm going to interpret that for you. Wow, that must be a smart one. Now, how can they tell by looking at a 12-foot gator? Can they see his brain, by the way? No. How can they tell he's smart? Say again.
Because it's 12 foot.
Because he's 12 foot. How did he get to be 12 feet?
He lived a while.
He's lived a while. And living a while, what had to happen?
He should be smart.
He had to be smart in order, by the way, do you think all alligators make it to be that long? No, I had 4 of them in the boat at my feet that proved that they don't all make it that long, right? By the way, do you think we got the 12-footer? No, I don't think we could have got it in the boat, right? I was glad that was someone else. Okay, long story short, you don't get to be a big company by being stupid. Now, does that mean that big companies don't do stupid things? Doesn't mean that at all, but it does mean that they do fewer stupid things. Okay, so there we go. Those are the reasons why small company stocks are more risky than large company stocks and therefore must return more. By the way, there is a question on the exam, and it's going to ask you what's riskiest, and it's going to list off like 3 things. And one of them is going to be small company stocks. What's the correct answer for the riskiest thing? Small company stocks, right? All you got to do is think back to this. And even if you can't remember this picture, you can remember why small companies are riskier than larger companies and why stocks are riskier than bonds. And you should always be able to put these things in order. And by the way, why long-term government bonds are riskier than treasury bills. Questions? By the way, where is my money right now? 80% of my money, of my retirement fund money, is in the S&P 500. 20% of my retirement fund money is in global equity. And we'll talk about why that is when we get to chapter 11. And then I have what I call my fund money. This is used like you guys use on fantasy sports and stuff like that. That is in the Russell 2000 and the S&P 600. What are those? Small stocks. Is it money I can afford to lose, just like the money you can afford to lose on fantasy sports, right? But am I having fun when things go well? Yes. Is it soul crushing when things go poorly? No. Does that make sense? Okay. Now let's talk about the pattern of returns over history. And what we have here are 2 things called histograms. And in a histogram, you divide stuff up into buckets. And the buckets here are 10% return increments. And so you can see we go from 0 to 10, 10 to 20, 20 to 30, and so forth. Okay, anytime that a return for a year falls within one of those buckets, we put the number of that year up there, and we use those numbers to build up a bar, right? Okay, now I want you to look at this structure of the histogram for large company stocks. What does it look like? Something you've seen before.
About 15%.
Say again?
Is that what you're saying?
Oh no, I'm asking for what is the shape of this thing? Yeah, it's the bell curve. What's another name?
Normal distribution.
Yeah, the normal distribution. And so that's our first clue that we're going to assume that stock returns are normally distributed. Now, is it a perfect assumption? Absolutely not. Number 1, the normal distribution goes on forever in both directions, but we know that stock returns are truncated. By the way, what's the lowest stock return you could possibly ever get? Oh, he says 0, and I'm going to say, oh my goodness, there were years when I would have loved to have gotten 0 return. Because it's actually possible to get negative returns. What is the largest possible negative return? How much? Yeah, minus 100%. Remember, stocks, you're dealing with limited liability. So the most you're ever going to lose is your investment in the company. Stock prices are never negative. Stock prices are never negative as a result of limited liability. So, what is the most I can ever lose on a stock? 100%, right? And so the worst return you can get is minus 100. And so this thing is truncated over here on this side at minus 100%. But theoretically, whoop, it does go all the way out on the other side. Okay, so that's the first problem with the assumption of the normal distribution. The second is that we say that stock returns have fat tails. What does that mean? I know it sounds exciting, but fat tails, it says we have more observations out here in the tails than we should. And so there are more extreme positive observations and there are more extreme negative observations. Now, just looking at a picture of it, you wouldn't see it, but when you put the mathematical constructs on it, you can see that these things aren't exactly normal. Okay. Now, all that said, in this class, we are going to assume that stock returns are normally distributed. And that is going to give us the ability to do some pretty amazing calculations. Okay, now, another thing I want you to learn from this picture is the relationship between time and stock returns. The year is 1926. What's your return? Between what and what?
0 and 10.
I think it's actually between 10 and 20, 1926.
Is large or small?
This is 1926.
Small.
There's 10 and there's 20. Oh yeah, I was still talking about large companies, sorry. Okay, so you're here between 10 and 20. You're talking to your friend and your friend's like, woohoo! I just got between 10 and 20% on my investment. And you're like, dang, I was only getting 2% down at the bank. And they're like, you should really put your money in the stock market. And you're like, I'll wait. 1927 rolls around. What's the return? Between 30 and 40%. Your friend says, hey, schmuck, look at my returns. What are you getting down at the bank? And I'm like, 2%. And then, what happens in 1928? 40 to 50%. I'm like, you know what? It's the end of 1928. We're at the New Year's party for 1929, and my friend says, and I'm like, okay, forget it. I'm going to go ahead, and I go all in on the stock market because I could tell that the stock market only goes up. Anytime you hear that, be very suspicious because it's not true, right? The stock market only goes up. Now, 1929, where's the return?
Minus 0.
Yeah, between 0 and minus 10. What happened in 1929?
Great Depression.
Well, it's the beginning of the Great Depression. It's the stock market crash in October of 29. So that means for the first 10 months of the year, we had fairly good returns. But then everything took a giant dump, and we're going between 0 and negative 10. And you say, well, undoubtedly that's just a correction. So I'm going to stay in stocks. What happens for 1930? Yeah, between minus 20 and minus 30. And you're like, surely next year will be better. What happens in 1931? Minus 40, minus 50. And you say, well, I'll give it one more year. Where's 1932? Yeah, between 0 and minus 10, you say, look, I'm tired of it. Basically, I don't have much left at all. You're just like, forget it. And so you sell all your stock, you get the money, and you put it under your mattress. What happens in 1933? 50 to 60% return. Why am I walking you through this? You can't tell what's going to happen next year based on what happened this year. It's at the end of, you guys probably don't remember, but December 2022, people are like, oh yeah, next year's going to suck. Next year's going to suck in the stock market, and if you're not in cash right now, you're a flipping idiot. I stayed in stocks because that's just my thing, right? I just stay in stocks. What did the S&P 500 return last year? 23, 24%? Could they tell what was going to happen? Absolutely not. And this is why I say you can't time the market, so you just stay in it. Because after all, remember what I told you about the S&P 500? Over time, you're going to get a nice return out of it. Now, next year may be crap. By the way, what happens when stocks just take a dive, especially for no apparent reason? What do? Buy more! 1987. By the way, I'm 16 years old, 1987. I'm sitting in the barber shop, because back then men went to barbers. Sitting in the barber shop, and the guy from next door, who's, by the way, a multimillionaire, but everyone in Carthage had to have a job, and he keeps running over, and he's like, hey, you know, the market's down this much, the market's down that much. And that night, we get home, and the phone's ringing off the hook, because my dad is known in the family as the guy that knows about the stock market. And all the relatives are like, Lee, should I sell, should I sell, should I sell? My dad's like, no, I'm buying. And at the time, I thought, you're a lunatic. But my dad was snapping up. In fact, Walmart was one of the things that he bought. Do you think he's done well on that? Oh, hell yes. Oh, yeah. Okay, so then flash forward in time, Brexit. I forget when that was. But I came into work that morning. The stock market was in the toilet because people were concerned that what Brexit was going to do to the economy. And I walked by my boss's office. He says, hey, what's up? I said, phew, I just pushed about $12,000 into the S&P 500. And he said, me too, right? And what happens? Usually, and this is not consistent with efficient markets, but usually what happens is people overreact. People overreact. We saw it with Brexit. We saw it with COVID. The trick is knowing where the bottom is. The Brexit news, all that news gets impounded right then.
Well, how did Brexit, which is EU, which was 2016 by the way.
Was it?
Yes.
Okay.
How did that affect us as we move out?
Okay, so global trade, right? We have globalized trade,
Right.
and we
I know
have,
it affected the EU, for sure, like with Greece
Right.
and all that stuff.
where do we send some of our exports? Everywhere, right? The EU. Did you know that?
Well, yeah.
Yeah. And so if things are going worse for them, how much of their stuff, of our stuff, do they buy? Less. By the way, it's a globalized economy. And there's only like one or two economies in the world that I really don't care what happens. North Korea is one of them, right? We have no idea what's going on, and they would like to keep it that way, right? Burkina Faso. Anybody here been to Burkina Faso? Do you guys know about, anybody know about Burkina Faso? It's tiny, it's very poor. How much do you think that they buy in American goods? Tiny amount, right? Overall, tomorrow, if Burkina Faso, if something terrible happened there, you wouldn't even see a blip. What if something terrible happened in Germany? Yeah, though we would know. Now, what's the difference? It's the size of the economy, right? It's not the kind of people that live there, it's the size of the economy. And so I'll give you an example. Do you guys know what the biggest economy in Africa is?
South Africa?
Second?
South Africa?
South Africa. I think it's actually, at this point, Nigeria. Yeah. What if something happens in Nigeria? What if there's a big coup in Nigeria? Yeah, you're going to see that, right? It's going to impact. By the way, what's Nigeria's biggest export? Oil. Do you think people care about oil? Yeah. Okay. Whew, we are way off in the weeds, but we're having a good time. Okay, so long story short, you can't predict what's going to happen in the market, but when you have these sharp events like Brexit, that bam, basically it's a done deal. It's like a stick being broken. You're going to see an overreaction to that, and then you're going to start to see a recovery pretty darn quickly. How's that different from COVID? Was COVID just like a stick breaking and we instantly knew? No. We were like, who's going to die next? Is it going to be me? Right? By the way, did I pull my money out during COVID? No. My only mistake in COVID was I pushed my money in too soon. I should have waited, but of course, I didn't know. Okay, now let's look at small company stocks. I want you to compare the shape of the small company stock distribution to that of large company stocks. Do you notice a difference? It's all jaggedy and stuff, right? It doesn't look as normal. That's the first thing. And the second thing is look at the range of returns. For large company stocks, it only goes from minus 50 up to plus 60. And for small company stocks, it goes from minus 60 up to 150. That's huge. That's huge. Now, we're going to see the riskier something is, the broader the distribution is. And in fact, when we start talking about the normal distribution, we'll say it's determined by two things, the mean and the standard deviation. The higher the risk, the higher the standard deviation, and the flatter this thing gets. So if you look at something very safe, we'll look at this picture and we'll come back and talk about risk premium. If you look at something very safe, for instance, like U.S. Treasury bills, the distribution looks kind of like a Christmas tree, a very skinny Christmas tree, right? And then as it starts to get riskier and riskier and riskier, this thing spreads out further and further. And the riskiest thing up here is small company stocks. And if you look at that as a normal distribution, for the really safe stuff, it would look like this. And for the really risky stuff, it's going to look like this. By the way, this reminds me of a fried egg from the side. You guys know what a fried egg is? This looks like a fried egg. That's a risky stuff right there, right? But this is safe. And we'll see more of that when we talk about the normal distribution. Okay, now let's go back to risk premium. Earlier we said that risk and reward must go together. That's the first thing we said. And the second thing we said was that there is such a thing as the risk-free rate of return. That's the amount of return you can expect to collect if you're not willing to take any risk. And we said our best estimate of that risk-free rate is the 3-month United States Treasury bill. Okay, now, anything over and above that is referred to as the risk premium. Because the only way you're going to get a higher return than the risk-free rate is by taking on risk. So the return you get over and above that must be compensation for taking on risk. By the way, we also refer to this as excess return. We also refer to this as excess return. We also refer to the risk premium as excess return. Why is it excess? It's the excess over the risk-free rate. You guys ever saw a show called American Greed on CNBC? No one? Okay. So let me tell you what happens. It's always some sort of scam that they're talking about. And here is the most common one. Hey, I've got this investment and it'll pay you really high returns and it's totally risk-free. What should your response be to such an offer?
Too good to be true.
Too good to be true. And by the way, if it seems too good to be true,
Probably is.
it probably is, right? I was going to go with a shorter response of bullshit, right? Because if it's offering these higher returns, it's not risk-free. Because a risk-free asset will only pay the risk-free rate. They don't have to pay any more than that. Why would they if the investment were truly risk-free? You'll say, wait a minute. Dr. Haggard told me there's no such thing as this situation you're describing. And they're like, hey, yeah, we've seen Haggard on YouTube. He's cool. But we have this insurance. And you say, well, wait a minute. Is it through the FDIC, the American government? And they say, no, it's better. And you say, better? And they're like, yeah, it's through Lloyd's of London. You guys know about Lloyd's of London? One of the biggest insurance, and it's not really a company, it's a marketplace. One of the world's biggest insurance markets in the world. You see ships getting sunk in places and there's oil spills. Lloyd's of London is the big insurer that's backing them up. And you say, ooh, I've heard of Lloyd's of London. How fancy. They're in London, right? And you're like, ooh, it's the queen. The queen's there. Oh, she's dead. The king's there, right? Okay, so you say, well, wait a minute. I want to see the paperwork because after all, you're a sharp cookie. And so what do? They bring out this certificate from Lloyd's of London. It says Lloyd's of London right on it. And it says that they insure all of this is risk-free and blah, blah, blah. And you go, must be true. Is it? It's total bullshit. Lloyd's of London does not insure anything like that. They don't. By the way, I told you about my friend who went to federal prison for 7 years for securities fraud. He said he basically has the equivalent of a bachelor's degree in graphic arts because he spent so much time trying to fake up financial statements. He said, I basically had a printing operation at my house where I was creating and printing up these fake statements. Do you think it would be easy enough to print up a fake document from Lloyd's of London? Absolutely. Oh yeah. I can prove it to you. I can fake one up and have it to you tomorrow.
I mean, they don't insure anything other than tangible.
You know, I don't know, but I can tell you this, they don't insure these scam investment things.
Like, well, I mean, would anybody insure a market?
Oh yeah, you can buy insurance for that sort of thing. For instance, the collateralized mortgage obligations during the housing boom.
Yeah, that's what caused that, huh?
Yeah, yeah, and it was idiots who did not know how to price risk. Okay, yeah, if you can find an insurance company gullible enough to insure your extraordinarily risky operations, more power to you, right? Okay, so that risk premium is just simply the return on the thing minus the risk-free rate. Now, let's skip forward here, and we've got all those things from the picture earlier, other than now we also have long-term corporate bonds. Forget inflation down at the bottom. At the bottom, we see United States Treasury bills, 3.6%. By the way, we said that these have near zero default risk, near zero price risk. We said this is our stand-in for the risk-free rate. So if I ask you to look at this chart and tell me the risk-free rate, what would you tell me? 3.6%. Okay, now let's start calculating some risk premiums. I'll try to pick ones that the math is fairly easy here. What would the risk premium on an intermediate term government bond be?
Would it be 5.5 minus the 3.6?
5.5 minus 3.6, and if my brain's working right, I think that's 1.9%. Now, if you guys need to use your calculator, feel free. I know they have handicapped you, right? By letting you use calculators from the day of your birth. It's just wrong. Okay, now moving on up. What about the risk premium on large company stocks? How much would it be? 8.2. 8.2, and how'd you get that number? 11.8 minus 3.6. We're always going to be subtracting that same risk-free rate. And so if I ask you, what about small company stocks? What would the risk premium be? 16.5 minus 3.6, which I think gives us 12.9, right? We always figure the risk premium or excess return in exactly the same way. What is my expected return on this thing? Minus the risk-free rate. Now notice what I just said there, the expected return. Do we know the return with certainty? No, because it's risky, right? Do we have to say the expected risk-free rate? No, we know it with certainty because it has no risk. Does that make sense? Okay, now let's talk about what is an expected return. The expected return is a swag. Have we talked about swags in here before? Does anyone know what a swag is? Okay, so here we go. By the way, everything I refer to here has to do with donkeys. So, don't freak out when I use this word. A wag is just a wild-ass guess. The kind of guess a wild donkey might make. A wild-ass guess. A swag is a scientific wild-ass guess. Right? Can you estimate the probabilities of different outcomes and what those outcomes would be? Yeah, absolutely. We can put together a swag. And so our expected return is a swag. By the way, let me tell you about another swag that you guys are run into. How many of you checked the forecast today? Do you think that that is known with certainty? No. Do you know what it is? It's a swag. And in fact, when they say, we expect a 1/4 inch of rain today, did you know that what they're really doing is they're saying, well, there's actually a 75% chance of no rain. And there's a 25% chance that it rains, and if it does rain, we'll get 1 inch. And so the expected amount of rainfall is 0.25 inches. So those are all just scientific wild-ass guesses. Okay, so that's all expected return is. So we're taking that expected return on whatever this thing is and subtracting the risk-free rate. That gives us the risk premium, and that is the reward you get for bearing the risk of the investment. Okay, now let's talk about risk. I've already talked about the thin and flat distributions. I want you to notice something here. It's a standard deviation. And we're going to get deeper into standard deviation. Once again, forget inflation. And I want you to notice something. With one exception, as the expected return gets higher, and we know the risk goes up, what happens to standard deviation? Yeah, it gets bigger, 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 right? And this is what we predicted earlier, that if something is riskier, the distribution is going to be more spread out, which means that standard deviation has to be higher. Now, here's the one anomaly. Here's a new word for you if you don't already know it. We have one anomaly up here. Our theory would predict that long-term corporate bonds would have a standard deviation between 9.7 and 20.2. What is it actually? 8.3, even though it has default risk that those long-term government bonds don't have. So that's a theoretical anomaly. However, check out the returns. Did the returns get it right? Yeah, the returns are counting for that. It's just the riskiness that isn't, or our measurement of riskiness, right? Now, should we allow one anomaly to cause us to throw the entire theory out? Absolutely not. You know, when I say I'm 95% sure that we're not going to get snow tomorrow, is there a chance we'll get snow tomorrow? Yeah. Okay, so leading into, we need a mathematical measure of risk. It's all fun and games to talk about smooth versus rough, but we really need to have some sort of mathematical measure. And you guys, in theory, have had some sort of statistics class. Do you guys remember standard deviation? Do you remember variance?
Yeah.
What's the relationship between standard deviation? Yes. Standard deviation is the square root of variance, or we could say variance is standard deviation squared. Both of those are fine mathematical measures of dispersion, let's call it dispersion. Dispersion about the mean. But we are going to choose one versus the other. We are going to choose to use standard deviation. And here's why, for two reasons. Number one, the units of standard deviation are the same as the units of return. The units of standard deviation are the same as the units of return. And so we can talk about standard deviation being 12% and the return being 4%. So they're in the same units, they're in comprehensible units, as opposed to variance. Variance is in units of percent squared. Variance is in units of percent squared. Now, and of course, I'm not the smartest, sharpest knife in the drawer, but I have had a lot of education, including way more statistics than I would hope to ever have learned. And I still cannot interpret percent squared. It's just not something my mind can wrap around. So I have a lot of trouble interpreting percent squared. So there's reason number one, is standard deviation is in understandable units. Reason number two, the normal distribution, and remember I told you we're going to assume that stock returns are normally distributed. The normal distribution can be determined using two things. Number one, the mean or expected return. And number two, the standard deviation of returns. And so if I have those two things, I can generate that entire normal distribution. If instead I'm talking about variance, you're going to have to do something before you can generate that distribution. You're going to have to take the square root of variance. And so for that reason, for those two reasons, we talk about standard deviation and not variance. Now, is variance still going to be an important part of our lives for chapters 10 and 11? Absolutely. Because for the most part, you end up calculating variance and then you have to find standard deviation from that. So I have bad news, we still have to be concerned about variance. Any questions so far? Okay, now for the moment you've been dreading, math. We are going to calculate sample standard deviation. Now let's talk about the two kinds of standard deviations we talked about. There is the sample standard deviation and there is population standard deviation. When you have information about the entire population, it's perfectly fine to calculate the population standard deviation. But when you're only grabbing a sample, then you have to use sample standard deviation. So the other day, I got into the elevator with my wife, who is female. And there were 6 other people in the elevator who, just guessing, were also female, right? And so here we are, 8 people on an elevator. 7 of whom are female. If I had used that sample to predict what proportion of people in Glass Hall were male, my sample mean would have been 14-something%, right? 1 out of 7, 8, 1 out of 8, so 12.5%, right? Would that have been correct? It would have been correct for that sample, but when we start to use these sample standard deviations, or these samples to draw inferences about entire populations, then we need to recognize that our estimate isn't as good as if it were a population standard deviation. And so the mathematics that we use here are going to help us along that path. Okay, by the way, everything you do in chapter 10 will be a sample standard deviation. Everything you do in chapter 11 will be a population standard deviation. Everything you do in chapter 10, you're going to see, I'm going to show you a very easy way to do it. But for chapter 11, you basically have to use the pick and blowtorch mathematical method that I will teach you. Okay, so here we go. We have 4 years of returns. And the first return is 13.7%, then we have 35.8%, 45.14%, and then minus 8.88%. I can convert each one of those into a decimal. And we typically do that when we're doing this kind of mathematics, especially if we're going to end up with variance, which we will. Okay, now, here's what I want to ask you. If you had to give me your very best bet of what the return is going to be next year, what would you do?
Average.
Average! We're just going to add those 4 numbers together, and then what are we going to divide by? 4, right? Because we got 4 samples, with a sample size of 4. We add them together, we divide by 4. The average is 0.8576, or the sum is 0.8576. We divide by 4, and that tells us 0.2144. The average, or the arithmetic mean is the fancy name for it, is 21.44%. This is a very important number because we're going to be using it for all sorts of calculations. In fact, what I would do is in your calculator, store 1, because we're going to be using that again and again. Now, let's see how we actually calculate standard deviation. we're going to start with the returns we've already been given. That's the column labeled as R. And then we're going to figure out the deviation of each one of those returns from the mean. The deviation from the mean is just how far away from the mean we are. And the way we do that is to take the return for each of the years and subtract that mean. Remember that mean is 0.2144. So we're going to take 0.137 minus 0.2144 is going to give me minus 0.0774. Are you with me so far? Okay, now the next year is 0.358 minus 0.2144 gives me 0.1436. And the next year is 0.4514. I'm subtract 0.2144, and that gives me 0.2370. And finally, by the way, you got to be careful here, minus 0.08888. Minus 0.2144 gives me minus 0.3032. If I add all those deviations together, what do you think I'm going to get? I'll get 0, right? Because the average deviation should be 0. Average deviation should be 0. Now, that tells us that figuring the average deviation isn't going to help us out. Now, we could do what's called the mean average deviation. No, sorry, mean absolute deviation, where we take the absolute value of those things and do an average of them. Do you guys know about absolute value? If you take the absolute value of a positive number, what do you get? Positive. If you take the absolute value of a negative number, what do you? Yeah, there you go. So it does tell you how far away you are from the mean. By the way, we don't care plus or minus. We're talking about how far away we are from the mean. Now, there's one other way to get rid of negatives. Square it. And so we're going to take each one of these deviations and we're going to square them. And so that first one, minus 0.0774, when I square it, gives me 0.0059976. And I can do that to each one of these. Notice that all of these squares are positive. That's just the way it always works, because a minus times a minus is a plus. Now, those are called the squared deviations. The squared deviations. And down at the bottom, I'm going to add all those up and come up with SSD. Any idea what SSD stands for?
Sum squared deviation.
Yeah, it's the sum of the squared deviations. The sum of the squared deviations. SSD is the sum of the squared deviations. Now, we can take the sum of the squared deviations and divide by n minus 1. What do you think n is?
Number.
That's the number of samples, right? So we've got 4 here, and we're going to subtract 1. And you say, wait a minute, why are we subtracting 1? Statisticians tell us that when we calculate the average of this set of numbers, we've already used some of the information from the data set. And we have used up one of our degrees of freedom. Have you guys remember this from statistics, the degrees of freedom? And therefore, we must divide not by n, but by n minus 1. That's for sample standard deviation. Now, if you ask me to explain what the heck a degree of freedom is, I will tell you to go visit with your statistics professor, right? That's not my ballgame. But I do know that this is the correct formula for sample standard, for variance with, so define sample standard deviation. Now, do we have sample standard deviation yet? No, what do we have to do? Square root. We have to do square root, and that brings us to 2.2413, or 24.13%. Now, next time we get together, the first thing I'm going to do is walk you through the easiest way to do this on the calculator without resorting to special magic tricks. The second thing that I'm going to do is teach you the special magic trick. Would you like to learn the special magic trick? It will make your life so much easier. I will see you next time.